Welcome back, Paulina. I feel like it's been a while since we talked economy, and a lot has changed since the last time. So we've got a lot to unpack today. My first question for you is, what are the most important economic factors impacting real estate right now?
Oh, hi, Kyle. It's good to be back. There's definitely a lot going on, and a lot is going on every single week. A lot is going on with the housing market, the economy overall. As usual, interest rates are probably the most important thing impacting the housing market, because the housing market is most sensitive to interest rate. Fed has the dual mandate. It looks at jobs and inflation. We had the jobs report come out and the CPI come out recently. So a lot to kind of unpack in both of these reports.
100%. Yeah, that was going to be my next question. So that's a perfect segue. So, as you know, on August 5th, the employment numbers came out, and they were really promising and showed that we had a strong labor market as 528,000 jobs were added. And on top of that, recently the CPI numbers came out, the Consumer Price Index, and it showed that the inflation numbers came down a little bit to 8.5%, which was lower than expected. So given all of that information, I know that's a lot to unpack, but this all ties into the Fed and how they're going to react with interest rates. So is that going to give them the green light to keep raising interest rates and proving that it's working, or what do you think they're going to do?
Well, I think we need to tackle this one at a time. Looking at the employment report, overall, it looks like a great one, but we also had the unemployment claims come out today. That's why you kind of have to take it day by day, because unemployment claims showed that things aren't as rosy. The 4-week average, which kind of smooths ups and downs, it rose by 4,500, and it's the highest since November. So it does show that there are layoffs. Unemployment applications are a proxy for layoffs, and they are an early indicator of where the job market is headed. So we might see a revision to that beautiful employment report. Also, there are some things within the report itself. We did recover to the pre-COVID levels overall. However, the leisure and hospitality employment is still 1.2 million lower than in February of 2020. Also, there are more part-time jobs. If you dig in, you will see that full-time employment is down for a second consecutive month, which is not a great thing. So when you dig in and look for more indicators, it does show some weakness. That's what I'm trying to say.
Yeah. So on that same light, what do you anticipate going forward? Because, as you mentioned previously, like there have been a lot of layoffs, particularly in, tech and other spaces. So how do we see this transitioning as we move forward? Do you think that's going to just be commonplace now, or do you think like that sector or those sectors will bounce back and things will kind of even out on that front?
I wouldn't worry as much about tech. I'm more worried that the overall labor participation rate is down, but not in the way everybody is thinking about it, right? Because I think that number might be permanently down. What you hear people say a lot is that it's because in general we had too much stimulus money and people are lazy. I personally don't think that's the case, because how long can you really live on stimulus money or stimulus savings? I'm sure that ran out a while back. If you look at the demographic trends, we do see a lot of baby boomers retire, and the Gen Zers who are graduating from college, it's a much smaller generation than the millennials. It's a smaller cohort that's entering the labor force right now. So I don't think we have enough people to replace the boomers that retired. So I think that overall the labor participation is going to be lower. At the same time, if you look at immigration numbers, they have been trending down for a while. So the overall just productivity and employment is not as impactful for GDP and output.
Definitely. Okay. So with that being said, how do jobs for those investing in real estate, how do jobs impact investors? Like why should investors be paying attention to jobs? Like, is it just for like long-term buy and hold investors who are renting out year by year and want to make sure their tenants are able to pay because they have a job, or are there other reasons too that investors should be paying attention to this number?
Well, investors should be paying attention to this number because it does directly impact interest rates, right? And interest rates impact real estate. So there is a lot that goes into confidence and interest rates. For example, one of the reasons why interest rates don't hold up is because investors don't see the strength in the economy, right? The Fed raised the fund rate by 75 basis points, and yet we've seen the 10-year yield go down. That's because investors are not bullish on the economy. They do see signs of weakness. And even though the bonds rallied on the employment report, they did take other things into consideration. So that's why they should pay attention to the employment number for sure. They should also pay attention to the inflation number. That's why I mentioned the dual mandate. That's how this number is important.
Yeah.
For investors in general, they should pay attention to construction. They should pay attention to just certain specific numbers within the employment report and wages. But overall, it's important to know where the interest rates are going.
100%. Yeah, let's talk about inflation too. So it seemed reassuring that inflation took a little bit of a dip this past month overall in the CPI. So I'd love to hear more about that. Are we seeing that because of the CPI has a variety of different things that are weighted within it? Are there certain things that dropped that are the things that led to this lower inflation number, or what are you seeing?
The biggest drop we've seen was in energy. And to be honest with you, I don't know what to think about that, because I know that we've been tapping into the Strategic Petroleum Reserve, and that's what lowered prices a little bit. I also know that when you look at the futures curve, it is in backwardation. And what that means is that investors do anticipate that the prices will fall in the future. And to me, it's interesting because it will be really hard to increase capacity in the future, just knowing what we know, right? What happened during COVID and how we decreased capacity, thinking that there won't be a lot of demand. And knowing what's going on with the war in Ukraine and how that impacted the supply of oil and what's going on around the world as well. So I want to watch that more closely, because I don't know whether investors are thinking that the demand will decline for oil because they anticipate a recession, or whether they think that there will be more supply. So that number was down. And it kind of offset the overall number. I think we have seen inflation peak. That said, some of the leading indicators for inflation are apartment rents and home price appreciation, because owner's equivalent rent and rent of primary residence make up 32% of that CPI number. And we have seen rents increase, I believe, 6.7% last month. And we still see the year-over-year appreciation of 14%. And that's a leading indicator. It takes about 6 months to show up in CPI. So that's still a pretty strong number. So we won't see that inflation number in that sector taper for a while.
Okay, now with the rent prices going up, is this still kind of like reactionary from like all of the time that it was kind of paused during COVID, and then all of a sudden landlords were able to up their rent at a certain point after all the mandates were over, or is this just a trend in general? Like, are we still on the backlash of COVID with this, or is this just showing that less people can afford houses, so more are renting? I'm just trying to get a better feel for that part of it.
It's I think it's everything. I don't think it's COVID. I think that it's definitely the lack of supply. We haven't been building enough homes. It's the uptick in household formations, demographics. People are forming households. People are living their lives. We haven't been building enough, yeah. Also, of course, if they aren't able to afford a home, they will be opting for renting.
Yeah, absolutely.
So
it's all interrelated.
House, of course.
And okay, so that's great. Now, my final question on this topic before we move on is, do you anticipate the Fed again raising interest rates in the upcoming month? And if so, do you think it's going to be like a half point or 75 BPS?
I do think that the Fed is paying attention to the unemployment claims and the employment numbers. Even though the report looks very robust, they should be taking everything into consideration. And though they probably didn't intend to raise 75 basis points, I don't think they will raise more than 50. There are some concerning indicators, right? That said, inflation is still there, and I don't think they should continue to be aggressive because there is weakness in the economy. That said, they did communicate that their number one objective is to tame inflation. So I do think they will continue to raise.
Okay.
So 50 basis points would be my guess.
Okay. So given that information and the fact that inflation is still very high at 8.5% compared to the target 2%, that would be like a healthy number of inflation. Investors are obviously impacted, and even like supply chain issues. All of these things kind of tie into margins getting tighter for investors, and not to mention house prices are going up as well. So should investors wait this out, or if not, what strategies can they employ to still have success in this current market condition?
So what's been interesting looking at the housing markets is we've seen inventory build up since the interest rates started going up, but in the last 4 weeks, new active listings have been trending down. So we need to wait and see a little bit to see what's going on there, because I'm afraid that what's been pushing home prices up is the lack of supply. So one of the decisions they will have to make is, whether they want to rent, where they don't know for sure how much the rent is going to be, versus own, where their monthly payment is fixed, and people will still be buying homes. Sellers have more power. They can decide to move or not decide to move. So I think that supply will dictate what's going to happen, and we don't see prices dropping. We don't see days on market increasing. I think the biggest concern for investors is going to be being able to secure capital for now. So I guess one of the concerns I have is that the number of active listings is trending down. So inventory might be declining. If you see a good opportunity, definitely don't wait around, because you might not have that many opportunities. One of the reasons we've seen cancellations with sellers is because, once they go under contract and they see a better property come on the market, they want that. If the inventory is declining, you might see fewer opportunities. So it's going to be a balancing act a little bit between the lack of capital and just seeing more available properties. I don't see interest rates holding up. I do think that whatever Fed is planning to do with interest rates has been priced in. I think that we need to definitely evaluate all the opportunities.
Yeah, absolutely. That's a very solid point. Well, I'll leave you with that. Thank you so much, Polina. As always, I love hearing your insights, and I'm sure our investors do too. So until next time, thanks again.
Yeah, but to leave you with one thought, if the interest rates are at 5% right now, and the inflation is at 8.5, just think that we're borrowing at a negative rate, and that's all I have to say.
That's
Until next time.
Until next time. Thanks again, Polina.